All right. Good morning. Welcome back here to Trader Money. Great to have you aboard. You go out, you look at the news, and you look at everything that's happening out there in the world right now. It's very easy to ask, is the market crashing? And I promised I would address this morning. So let's go and talk about it a little bit because when we look at the world and the situation that is happening out there, there are some concerns and valid concerns that the market is crashing and that all of these issues and whatnot are creating a crash element out there for stocks. Okay, so let's go take a look here at the chart. We'll start with the chart. And we can see here, this is a weekly chart of the S&P since 2018. Okay. And, here's 2020, big drop. We had a big drop here in 2018, government shutdown. We had this drop here in 2022. And then this is what this week's drop looks like. And you may need to zoom in or pull out a magnifying glass. It's not that big. We are not talking about a market that has crashed, okay? We are talking about a market that is weakening and struggling to find any footing to push into new highs after the summer rally. So, is the market crashing? No, it is not. And I think this is a really interesting thing because right now we have so many issues out there in the market. Possibly more issues than we've ever had if we really want to break it down from a seriousness of the issues. And here I've just listed a few, but Middle East affairs, I know yesterday the market was oscillating, bouncing up and down because we had Chairman Powell of the U.S. Fed speaking. But the move in stocks, yes, we had the oscillation, but when he was done speaking, stocks were pretty much normalized. In fact, they were up a little bit when he finished speaking. And then we got word of U.S. bases in the Middle East getting attacked by drones. In fact, 5 confirmed yesterday. And some of that news is trying to be downplayed. But the situation over there is absolutely escalating. It didn't look early like Iran or Hezbollah were going to get involved. Now it does. And it's a tricky situation for a lot of different reasons, okay? But that's not the only thing going on. There are a million other things happening. China economy, the economics in China are tanking. U.S. politics are a mess. We are heading into an election cycle for president, and it's a mess. We have inflation, which here in the U.S., in fact, we can go take a look at it. Trading economics here. And if we just want to come into, let's just go to the CPI here, U.S. Consumer Price Index, and let's just take a look at the inflation rate month over month. Core inflation rate, okay? And you can see that U.S. inflation rate has been falling and falling nicely. But even this week, we had a warning from the UK basically saying, hey, don't give up on inflation because other countries are still seeing inflation move higher. Other countries are still seeing a really negative impact when it comes to inflation and that it's not going away. And this is all creating bonds. One analyst this morning called it the worst bear market in bonds that they have seen. And that goes right along with, add that to the situation with Russia, Ukraine, which, does seem to be escalating every day, but isn't very much talked about. We have the housing issues here in the U.S. that continue to get worse. Even though we have a lot of analysts saying, hey, this isn't going to matter, it's not going to matter, it doesn't affect anything. We even saw Bank of America yesterday say it doesn't matter. They said the same thing about subprime. We have SEC changing some rules, which is always always something that creates some consternation out there. And then we're right in the middle of earnings season, and all in a situation and an environment where the market cap situation out there is historically different from what it has ever been. The market cap situation is so concentrated here with Google and Meta and Amazon and Tesla and Apple and Microsoft and Nvidia, that these companies are so big relative to a Boeing or a General Electric or even a Home Depot. The market cap is just so vastly different. It's something we've just never seen before out there in the market. So there are a lot of issues and a lot of reasons that we could make bearish arguments to say, hey, the market is on the verge of collapsing. It is on the verge of crashing. And, if we go look at bonds, we can say, yes, it is. Bonds are crashing. They absolutely are, and that's pushing rates higher. In fact, Bank of America data this morning showed that we're seeing more money leave money market accounts than ever before, but it's not going into stocks. It's actually going into bonds because rates are higher, so it makes it better to go after. But we are dealing with, a TLT, the 20-year Treasury bond ETF, that's back in 2011, 2012 levels. Which is pretty massive, and a major disruption, a major change here over the course of the last couple years, and is not showing signs of ending. In fact, the Fed this morning, one Fed governor came out this morning and said that the market's kind of doing their job, and the Fed doesn't expect to have to lower rates until late next year. Okay. Now, keep in mind what the market was pricing out this summer. The market was pricing out this summer that the Fed would lower rates by the end of the year, this year. Now we have the Fed coming out and saying, hey, it's not going to be until next year. And that is that's a big deal. That is definitely a big deal here. So anyway, that's a little bit of what is happening. So, okay, markets haven't crashed. Well, why haven't they crashed? Why haven't we seen, the S&P just hitting new lows and erasing all the gains on the year and being in this just massive crash with everything going on? What gives? Why aren't we seeing that? Well, it has a lot to do with this market cap situation, right? It's what is going on is a major negative for a lot of things. But when we look at the Middle East, and we look at the economic impact and the economic footprint, it isn't that big. And I don't want to downplay the human scale and human tragedy of everything that's going on there, because it is massive. Okay, that part is very sad, is very high. But when we talk just pure economic footprint, we're not talking about it being a massive economic footprint. Now, if oil prices spike and surge and everything else, okay, it will have a broader economic footprint. But overall, is what is happening in the Middle East, is it really affecting Apple? Does it really have an impact on Nvidia chip sales, Microsoft, Google, Amazon sales, Tesla, car sales? No, it really doesn't. The impact is so minor from an economic standpoint. And so you have the market sitting in this situation and going, okay, all right, in 1914, a terrorist attack basically caused World War I. We had a pretty major terrorist attack a couple weeks ago. Is this going to cause World War III? Because we do have dynamics in the Middle East that I don't know, we could say similar to World War I, but have some elements there associated here with them. And we have some very entrenched ideologies and nationalities, and we have we have a region of the world that is economically depressed. A lot of a lot of people out of work, a lot of young adults out of work, and looking for a cause, looking for something to, something to give them identity. And that can be a dangerous situation. And so, can it explode? It absolutely can. And if it does, then it brings China in and the UK in. I mean, UK has made some really interesting comments towards Iran, and it brings it brings the U.S. in, and it brings Iran in to greater degrees than what they already are. It can be a pretty massive thing, and so that is the market worry, because if that happens, we will see the markets move significantly lower. But the markets aren't moving significantly lower because the overall economic footprint isn't that great. And so, yeah, Apple, is it moving lower? Sure, it's moving lower, right? I'll tell you what's happening in the Middle East is not going to affect CRM sales at all. They're not going to affect Meta sales. And so we're going into this earnings season where the earnings are going to be pretty strong from these companies. They're going to be pretty weak outside of these companies. And, the market is, as analysts start to look at things, they go, wait a minute, we're going to see some acceleration in some earnings in some key areas. This is typically a real massive buy signal. And now we're seeing some unprecedented things here around the world. And when there's typically all this chaos, that's typically a sell signal. And so you have this dynamic, this contradiction that is occurring and that is happening, all while the Fed is sitting back and saying, hey, let the market do our job. Because what the Fed can't afford is for the markets to surge higher. And it's not like the Fed is under any pressure to rescue the market, because the market's still up this year. It's not like politicians are under any pressure to rescue the market, because the market is up this year. So the key incentive players don't really have any incentive to come rescue the markets. They have incentive to keep their powder dry. But we have this earnings situation that can be deemed bullish in a macroeconomic situation that is extremely bearish. And so it is perhaps one of the more unpredictable types of situations, especially when you look at the incentives of what happened, or what could carry on, and what could happen there in the Middle East. And it is one that we are seeing a sell reaction as bonds have broken down. But is this a crash? No, it is not a crash. Is it something where put options are extremely escalated in value? Yeah, it is. Is it one where I want to own a call option in free fall right here? No, it's not. Is it one where I would not be surprised to see the market break below its 200-day moving average and get some sort of very kind of massive bullish whipsaw back, similar to what we saw on the jobs report data? Right, and keep in mind that jobs report rally is now being erased, which is significant. No, and so what will I be doing? From a trade standpoint, I'll be waiting and just kind of watching, because I don't have a good reward to risk scenario on the downside for a lot of things, and it is dependent on things melting down. But it is a situation where we could see some exaggerated sell and some really nice reversal that sets up some strong reward to risk scenario. And I will be looking for stocks that have held up pretty well, not the free fallers. I won't be looking and saying, hey, you know what? This stock just absolutely got lambasted. It's been underperforming. It's been lagging. Let me go buy it. Like an airline, for instance. No, I'm not going to be looking to try to pick the bottom on these airlines. But when we look at some of these stocks that have held up extremely well in all of this, yeah, they're pulling back. Meta's pulling back. Okay, yes, if the market's going to sell off, Meta's going to pull back. But, it's held up extremely well. Now, can I get into it with earnings next week? No, but, we do have other things. And will I be looking to possibly get back into CRM? Sure. If we get a bullish signal in CRM, I'll jump right back in. ServiceNow, sure. I mean, here it's coming down to the lower Bollinger Band. Look for these types of stocks whose earnings and revenues are holding up and who are very strong. if we see some sort of market reversal or give us a good reward to risk ratio. But I can't just go out and say, hey, let me just buy them because they pulled back, because there is significant risk of a greater pullback to happen in the market. And we are seeing an erosion in the internals yesterday afternoon and this morning that we haven't seen all week. In terms of the market metrics, we're seeing a lot more stocks, cratering, and that is concerning. That is definitely concerning. Now, one thing that I do find interesting, and I can't show it here on screen, but the Bank of America Bull Bear Index hit 1.8 this week, 1.8 or 1.9, which is an extremely bearish situation. And one of those situations where, I think they said the historical return on stocks over the next month or 3 months, somewhere in that area, is about 6% after this type of reading, meaning stocks are likely to go higher after that type of reading. But whenever we're dealing with metrics like that, we always have to understand that they can stay bad while the market has a big drop. And these readings that, market rallies 5%, they normally look at the low of the market during that time. And so, you have to kind of say, hey, when is the low in, and expect 5%. And I don't think we can really say that the low is in here just yet. Okay. Let's see here. If we pull up the American, the AAII here, the individual investor survey, you can see the bearishness. It's up. It's up here this week, up here to about 34, but we're not extremely bearish. This is not showing that extreme move here just yet. And then the bullish reading, it's not extremely bullish or, under bullish or anything like that. So we're not seeing anything similar in these indicators. And one of the reasons why we are seeing the Bank of America index where it is because of bonds. The Bank of America index takes into consideration bonds, and with a historic move in bonds here, we're going to see some of those indicators, some of those extreme indicators that are contrarian, maybe signal some signals a little bit early. All right. So hopefully that gives a little bit of insight into, what is happening. Is the market crashing? What are some of the risks and scenarios out here? It's a mess. It is absolute chaos in so many areas. And so we go back to what we can control: risk, reward, exposure. And that's what we will do here for the challenge. Now, the challenge has not had a great start. I think what we have, five losers, one gainer, and the challenge is at 2,400. So if you told me we would have that win-loss ratio, I'd say, hey, the challenge is probably done. We probably need to start a new one. But no, we're still in a really good position to fight. We need one decent trade, and we are in the green. And in this market that has just been absolute chop, really since we started this challenge, I'll take it. But do need to be cautious, do need to be cognizant of the earnings season and the option values. We will get a lot more stocks here in the next week that come off of earnings where they're not priced into the option values anymore. So looking forward to that. We'll go from there. All right. Thanks for hopping on. If you have any other questions, please shoot them over to support@traderminute.com. Happy to help you out there. And we'll talk to you later. Take care.